In today's video, we're going to focus in on the final hour volatility that we saw inside of the Dow market. Now to get there, we'll compare and contrast the volatility inside of the S&P 500, the Dow, and the NASDAQ. Now if we start by taking a look at the morning volatility note that we sent out to all of our futures Volatility Box members, this is what our morning volatility landscape looked like. Now the morning volatility note contains our 10 major futures markets and what the volatility landscape looks like for each of these markets. Now that includes the 4 major indices, the S&P, the Dow, the NASDAQ, and the Russell, the 30-year note, crude, natural gas, and copper, and finally gold and silver. Now if you're not familiar with all of our models, we have 5 different volatility models available for these 10 futures markets we look at. They range in order from Scalper to Doomsday Aggressive, and I think the best way I know how to describe it is by using this line graph right here. Now the Scalper is our most aggressive volatility model. That's the one we use when we're trying to scalp when we have very little volatility in the major markets. This is essentially our most aggressive model. As we go down the line here to the Doomsday Conservative model, the Doomsday Conservative model is our most conservative model. We use that on days like, say, during the 2020 volatility during the COVID crash. So those are models which we typically reserve for the most volatile days. The Scalper is for less volatile days. Now with that, if we understand where each of the 4 major index markets currently stood today, we can see the ES and YM, so the S&P and the Dow, were both on their aggressive Volatility Box models, and the NASDAQ and the Russell were on their Scalper Volatility Box models. So if we were to plot that on this line graph here, the NASDAQ and the Russell are on the far left, and one level over, so essentially one volatility level higher, is where the S&P and the Dow is. And I even have an asterisk next to the Dow because we had an open test here. Now the interesting thing to point out here is by the end of the day, the S&P and the NASDAQ were both on their conservative Volatility Box models. So that gives you an idea of how the volatility increased in each of those markets. Meanwhile, the Dow, because it had still maintained its aggressive Volatility Box models, gave us a better entry where we knew that, hey, we have confidence here that the buyers are going to defend these levels. Now let's move straight to charts so you can see exactly what I'm talking about. Here I have the Dow futures with the aggressive Volatility Box models loaded on. Now first, let me show you why we aren't on the Scalper. The Scalper was very easily broken on in the morning, and using our 10-minute volatility test, it showed us that, hey, the Dow is on the aggressive Volatility Box models. Now, for most of the day here, the Dow just chopped in between our Volatility Box models. In the 10 to 11 a.m. Pacific hour, we even had a short side breach here, but that short side breach hit our first target before we had an opportunity to enter. Now, our entry in the Dow came in the final hour of the market, when we saw selling activity take place to start off that final hour. That selling activity took us straight into the aggressive Volatility Box. We can see with this green wick along with this red candle here, where price action breaches our sign entry lines. So that's step 1 of our fade setup. We need to see our Volatility Box levels get breached. Step 2, we're looking for the edge signal confirmation, that's this green arrow, which tells us that, hey, we're officially now in oversold territory, and we're looking at buyers to come in and defend these levels. Now, in this case, in the Dow futures, we had the edge signal, and we even had an opportunity to enter at the sign entry line, and a few opportunities for better pricing as well. Our stop on this trade was about 52 points, which was outside of the clouds, and we made that 52 points in this move up, where we went up to about 54 points. So this was the trade inside of the Dow on the aggressive Volatility Box models. Now, if we take a look at the S&P during the same time, the S&P was on its conservative Volatility Box models. So using the conservative models, we weren't anywhere close to our sign entry line. In fact, we were just chopping around sideways. We didn't have a volatility edge in the S&P. Same thing in the NASDAQ as well. So it was the Dow where we had the volatility edge, which we could take advantage of. And for all of our futures members, in case you're curious of the move which took us into the conservative models, it was the 8 to 9 a.m. Pacific hour breach which took us into those models. We had price action breach our sign entry lines. This was towards the end of the hour, so no capital at risk. And we were trying to see here, do the buyers defend these levels or do the sellers instead win out and bring price action lower? And here the sellers won. So that's where we broke outside of the aggressive. That took us to the doomsday aggressive, which was also broken. And finally, the conservative volatility box models. So one more time, the volatility today was interesting when you compare it to the beginning of the day to what the volatility looked like to end the day. The NQ and ES futures both were on their conservative models to end the day, while the Dow futures maintained steady on the aggressive volatility box and even gave us a nice entry in that final hour's trading when the other two markets, the other two major indices, were just chopping around in between their volatility models. I hope you found this video useful for all of our Futures Volatility Box members. If you have any questions, feel free to send us an email at contact@tosindicators.com. Take care, everyone. Good luck trading, and I'll see you in the next update.